You're watching Silver News Daily. Subscribe for more.
If the credit is not trusted, we could see silver outperform anything we've ever dreamed of in our lives.
Silver is about to do something almost no one is prepared for. Imagine watching fiat currencies crumble, governments scrambling, and amid the chaos, a quiet metal, silver, soaring by a mind-bending 10,000%. It sounds impossible, right? Yet history shows us that when faith in paper, money, collapses, real assets don't just rise, they explode. Today, we're standing at the crossroads of monetary history, where the cracks in the financial system are no longer hairline fractures. They're gaping chasms. Central banks are losing control. Inflation is biting harder than official numbers admit. And everywhere you look, trust in the dollar, the euro, the yen is eroding fast. Meanwhile, physical silver supplies are shrinking, ETFs are scrambling to meet demand, and premiums are quietly creeping higher. This isn't just another metals rally. It's the beginning of a historic reset. If you think you've seen silver rallies before, you haven't seen anything like what's coming. Stay with me, because once you see the full picture, you'll understand why silver's time isn't just near. It's already begun ticking down to detonation.
Sure. So we have not experienced healthy banking in our lifetimes, really not since pre-33. So only the very elderly even have a vague remembrance as a small child what healthy banking actually looks like. But we are going to be returning to it. I understand there's a lot of people out there that are dooming and glooming, that we're entering the techno dystopia and the CBDCs and, all that stuff. When this actually blows, there is no choice but to return to honest money, which is gold and silver, and people are not going to want to store honest money in their houses. They're going to want to vault them. So vaults will open up, and those vaults will turn into banks. And what banking is an incredibly complex service. It's this maelstrom of activity. Dollars are going in, dollars are going out. As I should say, bank credit's going in, bank credit's going out. The money sometimes leaves itself. The money comes in, the money itself goes out. Right. So all these things are happening, and it's a real profession in its own right. But when you boil it down to its essence, historically, banks have served three main purposes. So the first and primary purpose is what I said before. It's the protection of money, which is gold and silver, and a vaulting service. It's literally you take your bag of gold and silver down to the vault, and they put it in a vault for you. And they protect it for you, and they have round the clock security. They got the big vault door that they close that it takes 3 people to open, and a secret passcode that only they know, and all that other stuff. And they have it insured, all that kind of stuff. And that's called a demand deposit. So you can come by at any time. You can present your certificate of deposit to them, and they will give you back your money. But you have to pay for this service. I've covered this before on this channel. People are used to interest rates on their checking deposits. That is only a function of the fake money that we're currently using. On a sound money system, you have to pay for this. Nobody's going to pay to look at your gold for you, right? To protect your gold for you, just so they can look at it. So you have to sit, you pay, 0.5% or 1% per annum, and they sit there, they vault the gold for you, and it sits there being safe, right? Now, when we watch old movies, what do we see? And there's a lot, Hollywood has its, hand in everything, but what we see is in every movie, there's always a bank run. In these old movies, like Mary Poppins or It's a Wonderful Life, they show these bank runs where people suspect that the money they have deposited in the bank is not actually there anymore, and they run and they go and bang on the doors and the shutters close, and it's a remnant, it's a remembrance of what happened in the late 19th century and the early 20th century. And a healthy bank, I want to stress this point. A healthy bank does not care about bank runs on its deposits. An honest banker does not care at all if everyone rushes and bangs on the door and wants to get their deposits out, because he is simply providing a vaulting service. So if I am a healthy bank manager, or if I'm a manager of a healthy bank, and the rumor gets...
Silver's recent surge has been nothing short of electric, quietly outpacing gold and catching the attention of those who know how to read the early signs. Just this week, silver broke through the $33 mark during the Asian session, settling around $32.80 an ounce and outperforming gold in the process. This isn't just a random spike. It's a critical technical move. Labor Department data showed inflation wasn't as hot as expected, but instead of easing markets into complacency, it lit a fire under commodities. Silver responded like a coiled spring, breaking resistance levels that traders have been watching for months. Analysts are already pointing to strong support at $32 and seeing resistance forming around $33.25, right near a key triple top at $33.68. Why does this matter? Because these technical levels aren't just numbers on a screen. They're psychological battlegrounds where fortunes are made and lost. Every breakout confirms what insiders are already preparing for: the ignition phase of silver's next supercycle. And if you look closer, you'll see it's not just technicals. The broader economic backdrop is pouring gasoline on the fire. Silver's quietly mounting strength is signaling that something much bigger is unfolding just beneath the surface.
It's around that there's a bank run. I don't shutter the windows and close the door. I get a megaphone and I come out and I say, I have all your bank deposits, don't worry, and we're going to stay open extra late today, and we're not going to close the doors until each one of you gets their deposit back. And then I will walk down the line, shaking everyone's hand, assuring them that they have their deposits. They can take them out if they want, and if they feel comfortable, they can come back and bring it back. And so the bank run will just fizzle out because everyone's going to get their money, and then they're going to walk with this big bag of silver. They'll say, well, why am I holding this big bag of silver? This is dangerous. I'm going to go put it back in the bank. He didn't steal my money, right? So only dishonest banks fear bank runs. So if you watch the movie It's a Wonderful Life, when there is a bank run on George Bailey's bank, and he comes out there and he goes, I don't have your money. It's in your house, in your house, in your house. He was stealing the people's demand deposits. George Bailey was the criminal in that movie, not Potter. Potter was the hero. As usual, Hollywood gets it exactly wrong. So the second part of that is once they've deposited the money, the second thing that a bank will do is issue bank credit against the deposited money, because it's always easier to deal with credit than it is to deal with money. It's more convenient. Now, credit can be stolen. The banks can issue credit they don't have, which is the theft that we're currently engaged in. But in an honest banking system, people prefer to get a bank check, either a note or a check, versus holding the money directly. Because let's say I owe you let's say we're on a silver standard, and so $1 is 1 ounce of silver. Well, just for simplicity, and I owe you, Dunnigan, $100. That means I have to go to the bank and get $100 of coins. I mean, that's a big bag of coins. I look like one of those cartoon bank robbers when I'm walking out of there with the dollar sign on the bag. It's heavy, it's inconvenient, it's dangerous, right? And there's no tracking it, right? If there's a hole in the bottom of the bag and I didn't realize it, and half of the dollars went out, it's gone, right? But if I can use bank credit, so if I could get a bank note, I can just put that, it will say $100 on it. I can put that piece of paper in my pocket. It's light, it's convenient. No one knows I have it, which is very important, right? And it's easy to transfer to you. Even easier still in the modern world is I can just wire you $100, right? I could just type in, I could go to my bank account, it says send Dunnigan $100. The bank just subtract, it virtually moves the pile of silver from my pile in my bank account to your pile in your bank account, right? Even though the physical silver didn't change hands at all. So all that all that leads to many more trades and is much more efficient. And that
as silver flexes its muscles, a storm is brewing behind the scenes. And it's one that could send shockwaves through every market on the planet. Inflation, the silent thief of wealth, continues to nibble away at the value of paper currencies, despite the headlines trying to downplay it. The latest CPI data may have come in cooler than expected, but dig a little deeper, and you'll find core inflation pressures are still smoldering, just beneath the surface. Then layer on top the escalating tariff wars reignited by aggressive trade policies, policies that are shaking the foundations of global commerce. These tariffs aren't just about price hikes on consumer goods. They ripple through supply chains, increase costs across industries, and inject volatility into already fragile economic systems. And when uncertainty reigns, history shows that investors don't flee to stocks or bonds. They run to hard assets like silver. But this time, the setup is even more volatile. Monetary policies are trapped between trying to control inflation and avoiding a recession, leaving central banks boxed in and helpless. Every decision they make fuels the fire. Every hesitation widens the cracks. Against this backdrop, silver isn't just another safe haven. It's shaping up to be the only asset truly prepared to thrive when the economic storm breaks wide open.
That service is very, very convenient compared to just trying to deal with raw money, right? And the third thing that a healthy bank does is it acts as a middleman between lenders and borrowers. So there are people who have accounts at a bank and they say, you know what, I don't like paying this deposit fee. I would like to loan some of it out to a borrower, and then I will get interest on the bank. And I will get interest on the loan, sorry. And the bank will find a borrower, someone who wants to build a new house or start a new business, right? All these things. And they will connect the borrower to lender, and they take a little bit off the spread. And that loan is called a time deposit. And that's the difference between a time deposit and a demand deposit is that time deposit, that money is locked in for the duration of that loan. You cannot get it back. And so when there's a bank run, the bank can say, well, we can give you a demand deposit, but your time deposit is locked in here. You signed the paperwork, right? That's not your money right now. When it comes back to you, it will be your money once again. So these three fundamental functions of banking, currently modern banks, what we call banks, only provide the second service and a little bit of the third service. The first service is provided by precious metals vaults. So, when you buy an IRA, or when you put your money in an IRA, they vault your gold for you. It's the precious metals vaults. They store the gold and silver, but it's in a much more illiquid manner than it would be in a traditional bank. But it has to be because they're not allowed to call themselves banks, right? Peter Schiff tried this, and he got hell rained upon him for trying to make a gold standard bank. So they can do, a company like Monetary Metals provides the third service. But they cannot call themselves a bank. They can't. No single institution provide all three of these services because of the current banking system is kind of elbowing the honest brokers out and forcing us to use the fiat currency, which they are. The modern banks are issuing fractionally reserved bank credit against fractionally backed notes in this never-ending Ponzi scheme. But I promise, once this blows, we must return to the fundamental principles of banking that I just talked about before. And people ask, well, how will banks, if we return to an honest banking system, won't this whole system just start again, right? Won't banks just, steal from the people, start issuing notes they don't have again in a free market, right? And the answer is no, because banks actually compete with each other on interest.
Silver isn't just riding the winds of financial fear. It's being propelled by a force far more powerful and long-lasting: industrial demand. Unlike gold, which sits quietly in vaults as a pure store of value, silver is the lifeblood of modern technology. It's the irreplaceable metal woven into the very fabric of the future. From electric vehicles to solar panels to the 5G infrastructure connecting the world. In 2025 alone, industrial consumption of silver has smashed previous records, and it shows no signs of slowing down. The solar industry in particular has become a silver-devouring machine, accounting for nearly 20% of all global demand, with new government mandates and clean energy revolutions ensuring that figure only grows. And here's the kicker. While industrial usage soars, there's no easy substitute. Silver's conductivity and resilience are unmatched, meaning industries can't just pivot to another material when prices rise. They're locked in. This double-edged sword of booming industrial demand and inelastic supply is a pressure cooker ready to blow the lid off silver prices. Unlike speculative rallies of the past, this surge is being underpinned by hard, inescapable fundamentals. Every EV rolling off a production line, every new solar installation, every 5G antenna built, all are quietly tightening the noose around the global silver supply, setting the stage for a price explosion that could shock even the most bullish investors.
Rates for loans and deposit fees in a free market system, right? Just kidding. So banks are trying to attract customers and on both the borrowing and the deposit side. So a depositor is going to look and say, what are the fees? Because remember, you have to pay to deposit and to demand deposit. So they'll say, what are the fees to deposit at each of these banks? And if they're all flat, then it doesn't really matter. But if one bank has substantially lower fees than the other banks, what happens? All the depositors run over there. Now, how is that bank? All the other bankers are going to sit there and say, how is that one bank able to provide much lower fees than we have? And they go, They do all the calculations and they think, you know what? We think that bank is engaging in fractional reserve banking. Because if you don't actually have the money that you say you have, Dunnigan, it's a lot easier to provide lower interest rates, it turns out, right? So what the honest banks will do is what Potter does in It's a Wonderful Life. He announces to the whole town, he says, George Bailey doesn't have the money in his vault that he says he has. And so the people start panicking and banging on the door. And then Potter comes out and he says, I will give you 50 cents on the dollar for your ticket, for your demand deposits at Bailey's bank. So some of the people take that, right? They take the 50 cents on the dollar because they think, well, if I don't do that, I'm going to lose everything. And then Potter shows up with the pile of receipts and says, I want the gold. You owe me the gold that's backing these receipts, right? And once again, an honest bank doesn't care. They say, here's the gold, right? And the bank run would fail. That bank attack would fail. But a dishonest bank would fail that test. So they shutter the windows, close the doors, and the bank manager skips down on the next train, right? So that's the competition between banks is what keeps the system healthy in a free market. Now, what happened in the 1890s through the 1910s was they centralized the banking system, right? And into the 1920s and 30s, they centralized the banking system, and we had the Federal Reserve Bank that would prevents these banks from attacking each other. No one's allowed to attack each other anymore. And so the point, I think Rafi said this once, and it's a brilliant observation, there's really only one bank, right? Because these banks are all so interconnected now that if any one bank fails, they all start to tumble right away. And the Federal Reserve have to come in and, quickly patch up the system before it blows up again. So we will see, on the other side, we absolutely will see healthy banking. I'm not worried about that at all. It would just be by necessity. We're going to go back to what the roots of free market banking were.
While silver's industrial demand story is electrifying, the silent crisis that could truly send prices into orbit is unfolding right now in the physical market. Beneath the surface, physical silver shortages are becoming more severe by the day. Major silver ETFs, like SLV and SIVR, are reporting tighter inventories, even as demand surges. Mining production, which once promised endless supply, is now sputtering, unable to keep up with the relentless appetite from both industry and investors. Premiums on physical silver, once negligible, have started creeping higher, a quiet signal that available supply is vanishing faster than most realize. Wholesalers are already warning that delays and back orders are becoming the new normal, and that's while the broader public is still mostly asleep to what's happening. Imagine what will happen when the herd finally wakes up. When confidence in fiat currencies cracks wide open, it won't be charts and ETFs people are scrambling for. It'll be physical metal, and when that panic sets in, it won't just be a matter of paying a few extra dollars in premiums. It will be a matter of whether you can get any silver at all. This is the hidden fault line in the market, one that's already trembling under the pressure of growing demand. And when it finally ruptures, the scramble for physical silver could make previous bull runs look like quiet strolls by comparison.
I'm calling for a catalytic change. Like the world we're going to be on the other side is going to look very, very different than the world we're currently in. And I don't think CBDCs and the techno dystopia is something we have to worry about, and because the market gets a vote too. And you can deceive, like, what's that? You can deceive some of the people some of the time. You can deceive
all of the people some of the time, and some of the people.
You can't fool everybody all the time. It's been almost a century of people getting fooled, but it cannot last forever. I absolutely promise that. It cannot last forever. And this actually brings into the second one, which is silver's role as a monetary safeguard against excess gold certificates being printed. So silver, which you were going to ask me that, but I'll ask myself that question. So silver is the people's money, right? The banks don't write credit notes off of silver. They write credit notes off of gold. Now, silver has always been the direct money, and it can be used to, because there were silver dollars and there were silver certificates. Never mind. Banks did issue some certificates off of silver, but the Federal Reserve note is a note off of gold, right? So when you demand a dollar, you could demand a silver dollar, or you could demand a Federal Reserve note, right? The free market never demonetized silver. The people didn't wake up one day and, you know what? We don't like silver anymore. We just want to use gold in and of itself, right? In 1873, the government started suppressing silver. They basically took silver and pushed its head underwater until the bubbles stopped coming up. But the suppression, it was suppressed it can be suppressed as a money. It cannot be demonetized. That's what I'm trying to say. So you can tell everybody, just like every other Ponzi scheme, don't ignore that stuff that has intrinsic value that people have valued for thousands of years. But take what wealth you were going to store in my new product, which are these fancy new certificates that are theoretically backed by gold, right? It can be suppressed as a money, and it's been suppressed as a money since 1873 in favor of gold. And anyone who gets caught on the wrong side of a suppression of silver gets massively hurt by it. In 1970, this is slightly before my time, but in 1979, 1980, right, the silver price went up to $50. And if anyone jumped, all the libertarians, I'm sure, said, "Oh, we're going back to a silver standard. It's the gold. It's the new golden age of our lives." And then, of course, Volcker comes in, and anybody, who's buying, YOLOing into silver at $50, they still have not gotten their dollars back after, 40, 50 years later. So,
amid all the chaos building under the surface, there's one signal flashing louder than any other for those who know where to look: the gold to silver ratio. Right now, it's hovering around 100, a level that has historically screamed one thing: silver is massively undervalued. Every time this ratio stretches this wide, a violent reversion follows, with silver exploding upward in a desperate sprint to catch up to gold's lead. Think back to 1980, when the gold-to-silver ratio collapsed from over 80 to below 20. Silver didn't just rise, it detonated, soaring nearly 800% in a matter of months. The same happened in 2011, when silver rocketed from under $10 to almost $50 in less than 3 years. And today, the setup is even more extreme. Gold is already hitting new records, fueled by central bank buying and investor fear. But silver? It's lagging at a fraction of its historical highs, coiling tighter and tighter like a spring wound to its breaking point. The ratio isn't just a number. It's a mirror reflecting how distorted, how stretched, how unsustainable the current market really is. When silver finally breaks free, it won't be a slow climb. It will be a slingshot move, fast, brutal, and without warning. And by the time most realize what's happening, the window of opportunity will have already slammed shut.
Bad as that was, it cannot be suppressed forever, and it can never be truly demonetized, because when you know what money is the most liquid commodity in a market. That's definitionally what it is. And silver, not gold, is actually the most liquid commodity in a market. So it's an intrinsic property of the metal itself within the constructs of our market. Now, that doesn't mean a scientist can look at the silver and look it under a microscope and say, "Oh, there's the liquidity right there. I can see it," right? Liquidity is a function of the market itself. But within the function, the construct of a free market, silver is the most liquid direct money. So even in its suppressed state, so even with the central banks, the bullion banks, they have all these notes for silver the silver that doesn't exist, and the silver's futures contracts and the games they play with silver, and like I said, they're sticking silver's head underwater until the bubbles stop coming out. Even in its suppressed form, you can still store your wealth in silver now because the price can't get any lower. They're doing all they can, and silver is like slowly raising its head up, trying to get a gasp of air, and eventually it's gonna, do a Hulk and throw off its shackles. But even right now in its suppressed state, you can still store your wealth in the form of silver. You can collect silver and store it into your vaults, right? So the very act of converting your dollars into silver, when people call you or Miles Franklin directly and they say, we want to convert our dollars into silver, what they are saying is, they're telling the banking sector, I do not believe the gold certificates you have issued are accurately backed up by redeemable gold, right? So the same can be done with gold. I mean, you can call Miles Franklin to get gold, but the problem with gold is that it's so high powered, right, that it's not easy to do in small increments. So what's 1 ounce of gold right now? It's $3,300. So I could, take $3,300 and go get an ounce of gold. But what does that leave me? That leaves me with one coin, so I can make one single transaction worth $3,300, or I can start shaving it off. But then the currency, the difference between money and currency is a standardized weight of money. So if I start shaving the coin off, even though the gold is still money, however, now it has to be weighed, it has to be tested every time, and people might say, I don't trust that half coin of gold. I don't know, right? So you can keep with silver, you can keep it into small coins much more easily than you can with gold. And that actually brings me into the third question, which I will leave it to you.
If you really want to understand just how explosive this coming silver move could be, you have to look beyond the bullion and into the silver miners, the hidden amplifiers of wealth. History has shown us time and time again that when silver runs, mining stocks don't just tag along. They outpace physical silver by magnitudes. In past silver bull markets, while the metal itself delivered stunning triple-digit gains, top silver miners handed early investors returns of 500% or more. And the setup today is even more compelling. The Global X Silver Miners ETF, SIL, is already up 25% year-to-date, outpacing physical silver's own impressive rise, and yet valuations for many of these companies remain deeply discounted compared to their historical norms. Junior miners accessed through funds like SILJ are showing signs of early accumulation, hinting that smart money is already positioning ahead of the inevitable rush. These miners are essentially leveraged plays on silver. Small movements in the metal's price can create outsized impacts on their earnings, and by extension, their share prices. But here's the real kicker. As physical shortages worsen and silver's price pressure intensifies, miners with access to actual in-ground resources could see a frenzy of interest, sending their valuations into the stratosphere. In a true silver squeeze, it won't just be the metal making headlines. It'll be the miners delivering life-changing gains for those who saw the writing on the wall.
So there's a lot of active discussion in this space about what is silver's future, what this is all going to look like. And I'm absolutely calling for at least temporarily fully monetized silver again. So that's the 15-to-1 silver to gold ratio. And I've talked about this before on your show. That's the period of time when you can buy the mansion in Brooklyn for 100 ounces of silver. People are desperate to get even a little bit of silver, and you buy all the assets in sight. That's not quite what I'm talking about here, or what I'm going to cover here, because I've already covered that, right? I'm going to cover what we're going to see after this, right? After the crash, when life starts to return back to a normalized life on an honest money system, whether that be just a gold standard or some sort of bimetallism with gold and silver. So I personally would love to see a return to a silver standard, like, a pre-1873 silver standard. I don't think this will happen for long. And I get this question a lot from people who say, Phil, why do you think it's not going to stay at 15 to 1? Why should I? People email me, I want to get into silver, but I'm worried, how do I know it's going to spike to 15 to 1? How do you know it's not going to stay at 15 to 1? Where are you getting these ideas from? And the answer is credit. The answer to this question is credit. Why silver's not going to stay at 15 to 1. There are two ways to buy things done. Again, there is money and there is credit for money, right? Those are the only two ways, like I said before. And the most basic form of credit is the note, right? The physical paper note. But there's additional credit beyond that, right? There's the wire transfer, or the bank account transfer, like I talked to you before, where I can just send you some money. There's Venmo, there's PayPal, right? And each of these is more convenient and more secure than the method before it. So the bag of money it's the most honest, but it's the least secure and the least convenient, right? Because I have to cart physical money over to you. With a physical note, I can put it in my pocket. But again, I could be, a guy could think I have this note in my pocket, so he could come and try and rob me at gunpoint, and then I have to hand the note over to him. If it's a bank transfer, I can do it like this, right? Or I could, pull out a credit card, and then if he steals my credit card, I can call the credit card company and cancel the cards, right? And now the next one is the biometric scanning. You go to the grocery store, and now you can wave your hand at the thing, and that is impossible to steal from. I mean, it has its down. I don't recommend this. I think this is very dystopian, but it is impossible for a thief to steal from you. He would have to kill you and cut off your hand, and then hold a severed hand up to the up to the cashier, right? So, and that's not going to work anymore. So this, each round of credit is getting more and more secure. I'm not saying it's perfect. Absolutely has its downsides, and I'm against the biometric scanning, for the record, for all the viewers, right? But as long as the credit is trusted at each step of these, as long as the credit is trusted, it doesn't actually have to be there, which is because
as the silver market tightens and the miners quietly prepare for a breakout, an even bigger threat looms: the inevitable implosion of fiat currencies. We are witnessing the slow-motion collapse of a system built on trust, a system where money is printed without restraint, where debts are rolled over endlessly, and where central banks are trapped by their own policies. The warning signs are everywhere. Global debt has crossed the $300 trillion mark. Nations are debasing their currencies to stay afloat, and the average citizen's purchasing power is eroding faster than they can adjust. Meanwhile, central banks themselves are hoarding gold at record levels, preparing for a monetary landscape where paper promises will no longer hold value. But if gold is their safe haven, silver is the untold story. The asset that not only protects wealth, but has the potential to multiply it. The very fabric of the current financial system is fraying, and once the tipping point is reached, confidence will evaporate overnight. In a fiat collapse scenario, silver isn't just insurance, it's survival. And the clock is ticking. Every warning, every policy blunder, every desperate measure from central banks is another crack in the dam. When it finally bursts, the rush into tangible assets will be ferocious, and those who hesitated will be left with nothing but worthless paper and a bitter lesson in lost opportunity.
They're stealing from us right now. But as long as the people trust it, as long as the people think the credit is trustworthy, credit will beat money hands down every time as a medium of exchange. Is so much more convenient. If you look back to what people had to do to pay the bills in like the 1920s or 1930s, so that, there's a movie Cinderella Man, and it's about a boxer in the Great Depression. And there's a scene, it's this throwaway scene. I don't know why it sticks in my head, maybe because it's monetary. But the power man, the electric man comes, he's, banging on the door. He's, you owe me 35 cents for this month's electricity. And of course it's the Depression and the mother doesn't have it. So he goes and, flips the switch and turns off the electricity. So they actually had because they were dealing with silver and actual money notes, they had to have a man come by in an armored car to physically take the money out of your hand. And that was a job, right? That was somebody's job, was to go collect the silver and put it in the car and then drive it off to the to pay for the electricity, right? Now it's so much more convenient. It's auto pay, right? I don't even know what my electric bill is most of the time. I get an email once a quarter that I check, or once a month that I check. But you know, because credit has made life so convenient, people are going to want credit again. And I don't know. The credit chains right now are impossibly long. I mean, they're infinitely long because they're trying to convince us that credit is in fact money. We're definitely going to see much smaller credit chains before money actually has to change hands again. We're not going to see what we're seeing right now. I don't know where it's going to land, Dunnigan. If the gold credit is trusted quick, so if the crash happens and the gold credit, all the gold's in Fort Knox. Donald Trump melts it down into little coins and distributes them on the banking sector. And the free market banks start issuing bank credit again. And people say, oh, thank God we have these notes again. We trust it. Everything's fine. Everything's fully redeemable. We could see a quick return to a pure gold standard, in which case silver is not necessary as a money because you can just use gold credits. However, silver will always, Dunnigan, be the backstop to distrusted gold credits. It will always be there for you. And all that said, I want to add one other thing here. If the credit is not trusted, we could see silver outperform anything we've ever dreamed of in our lives. And here is why. So silver comes out of the ground in an 8 to 1 ratio, not 18 to 1, 8 to 1 ratio with gold, right? And the most of the above ground silver supply has already been
Everything we've discussed leads to one unavoidable truth. Silver's moment is coming, and when it arrives, it could reshape wealth in ways few can even imagine. A 10,000% surge might sound extreme, but history shows us that in times of monetary resets and fiat collapse, extreme moves become the new normal. The fundamentals are in place: an overstretched financial system, rampant currency debasement, exploding industrial demand, and a tightening grip on physical supply. Silver isn't just positioned to rise, it's positioned to detonate. Those who act now could find themselves on the right side of history, holding one of the few assets that not only survives but thrives through the chaos ahead. If you found this breakdown valuable, make sure you subscribe to stay ahead of the financial reset and prepare yourself for what's coming. And remember, this is not financial advice. Always speak to a professional before making any financial decisions.
Consumed by industrial uses. So the actual above ground silver supply right now is lower than the gold supply. There's less available silver than gold. And additionally, the world's population is dramatically larger than it was in 1963, or really any point you want to look at in the past where we were using silver even vaguely, like we were in 1963, the world's population is dramatically larger than it was. And there are more goods and services competing for money than there ever were in 1963 as well. So if you fundamentally think about what money is, it's the medium of exchange between goods and services among people, right? So if there's more people, and there's more goods and services, and there's less money, then one would think that, logically, it would infer that the purchasing power of that money will be drastically higher. Now, I'm agnostic on this point. I've been chatting with other people in this space who are making this point, and I want to present it to the audience. I think it could happen. I'm not specifically calling for it, but what we could see is even with just a 15 to 1 ratio, we could see that silver, the purchasing power of silver, dwarfs anything we thought it would in the past. So in the 1920s, 50 cents bought you a steak dinner with wine and a tip for the waiter in Manhattan, right? We could, and those were two 90% silver quarters. What we could see, because there's so much less silver available, they're going to have to alloy it with copper. So we're probably going to see, in this scenario, what we're going to see is, the new quarters are going to maybe be 10% silver, 90% copper, but they'll have the 10% silver in there. And that silver will be so unbelievably valuable that the price of a Manhattan, the price of a steak dinner in Manhattan with wine and a tip for the waiter will be 50 cents. But the coins will only be 10% silver instead of 90% silver. So that purchasing power will have dramatically increased in terms of what silver can buy. And once again, this entire premise that I'm making is entirely depends on gold's ability and the bank's ability to issue trustworthy credit. If we return to trustworthy credit very, very quickly, we probably won't see this. We will absolutely see the 15-to-1 temporary crash where you go buy the personal aircraft for a couple of rounds of silver. We will see that. What I'm talking about is an extended period of extreme silver purchasing power. That I am agnostic on. However, I am presenting it to you and the audience here. I would say temper your expectations on this particular claim, but if it happens, jump in, enjoy the ride.